Ladies and gentlemen, there are three ways that you can use when you are doing your investments, or actually when you are investing in other classes of assets, such as money market funds, or buying stocks, buying shares, or if you are that person who is called uh, an active trader, right? Now, there are three ways in which you can maximize profits. And number one, we are talking about buying and holding. Buying and holding. And holding. Now, when you talk about buying and holding, is actually when you buy assets and hold them for a prolonged period of time. For example, 30 years, 20 years, 40 years, and so on and so on. Now, if you decide to buy shares of a company, for example, when a share is trading at 1.50 Kenya shillings, when a share is trading at 1.5, and then you buy how many shares? Let's say you buy 20,000 shares, right? You buy 20,000 shares. This is equivalent to how much Kenya shillings? This is equivalent to, is it 30,000? 20,000 times 1.5. This is equivalent to 30,000 Kenya shillings. Now, assuming that you give the share price of this particular company 20 years, and then you realize that the share price is going to go up to Kenya shillings 65 Kenya shillings. Yeah, up to Kenya shillings 65. Remember, you had an initial investment of 30,000. You bought shares when they were at shillings 1.50, but you have hold them for a longer period of time so that you can realize the gains, right? Now is at 65 Kenya shillings. Now, Ebu multiply by the number of shares you hold in that particular company by 20,000, right? Now, this is the advantage of the power of buying and holding, right? The power of buying and holding. So this one is going to be 65 times 20,000. So this is 1.3 million, 1,300,000. So after 20 years, you will have value in assets of 1,300,000. Look back up before 20 years, you had value in shares of 30,000. This is capital gains. There is a saying that we normally say, sijui kama ushaisikia hiyo saying yenye nasemanga, time in the market beats timing the market. Time in the market beats timing the market. This is whereby when you stay in the market for a long period of time without doing anything, kazi yako ni kununua na kuhold, kununua na kuhold. Actually, you might realize a lot of gains other than that person who is timing the market. Market timers are those people who are going to do active trading, daily trading, or they are going to trade regularly, buying and selling of stocks and so on and so on. They time the market. They identify where the market is up and when the market is down, so that they can know where to sell and when to buy. They are going to shift shares or investments from one investment account to the other investment account. And you know what? They are going to incur a lot of transaction cost because they are trading each and every time. And remember, even the aspect of taxes, they are going to be taxed, and high brokerage fees, because of course they are the transactions are through brokers, because they are transferring shares from one person to the other, and of course they are using those accounts, and there have to be brokerage fees. But if you compare with someone who is actually staying in the market, the person who takes time in the market, like for example this person who buys shares at shillings 1.50 and waits for a period of 30 years or 20 years for the share to appreciate to 65 shillings. Now look at that. Unlike the market timers, whereby you are going to be an active trader, but in most cases you are going to incur losses, because it's not all the time that you are going to be in the market. Probably the times that you miss in the market is where you had an opportunity to actually gain some profits. But when the time you are in the market is where you don't have the opportunity to make some profits. So it becomes challenging to know or to predict when the market is actually going to give you some returns, or when it's going to do well for you to gain some. And it is exhaustive. It is tiresome, because it's going to require you to be there. It's actually, you become a slave when you become a trader in the live stock trading and so on and so on. But I'm not saying that you should not trade, because there are experts who normally do that, because an investor who is going to take time in the market is comfortable looking for 10% increase per annum. But there is this person who wants 10% per day. So this is the person who is going to time the market. So they take extra risk. But an investor who doesn't want to, who is a risk averse person, is going to look for this 10% in a year. But this person, of course, for you to get this 10% per day, then it takes you a lot of time, a lot of effort, a lot of studying, a lot of monitoring, and so on and so on. So you have to provide more of yourself, all right? Now, that is just an example of buying and holding. And another example is when we can use a money market fund account, right? Another example is where you can use a money market fund account. Now, assume that you buy 500,000, investment worth 500,000, or simply you deposit money in a money market fund for 500,000. That is 500,000, 500K. Now, and you decide that you're going to hold this money for a period of how many years? Let's say 30 years. So after 30 years, this is how it's going to look like. So future value, because you have the present value here, and present value is your 500K, is equals to 1 plus R over F raised to power NF. All right. So future value is equal to 500K, 1 plus 0.12 over 365. This is N, 30 years times 365. Now, 365 is the frequency of compounding, and frequency of compounding in a money market fund is that is daily. That's why I'm putting 365 in a year. Now, I've just taken a 0.12% hypothetical interest rate, but it could vary with the markets and the other things, the factors that are associated with the market. But the reason why I'm taking 12% is because you realize the interest rates can go high up to 18%, but they can go low up to 9 or 10%. That's why I take an amount that is just in between there, a hypothetical amount, all right? Now, if you do this calculation, let's do this very fast. So this one is 0.12 divided by 365 plus 1 raised to power 365 times 30 times 500,000. So this one is going to be roughly 18.3 million. Now, you see, what does this person have? What has this person done? This person, you deposit 500,000 and you decided that you're not going to withdraw the interest. So you reinvested the interest in the same money market fund account instead of withdrawing. Now, when it comes to buying of shares, you can actually buy stocks, and instead of eating the dividends, you reinvest the dividends in the same account. You get what I'm saying? You reinvest the dividends as one of the ways of maximizing the returns in long run. And of course, you are going to find out that you have actually gained a lot of interest, and so on and so on. This one is another way of, instead of withdrawing the funds, even those people who not unless the goal of you investing in a money market fund account was actually for passive income, so that you can be getting some amount out of it. But you can hold this up to 18 million. Then at your retirement age, now you can start taking your interest out and actually enjoying it. Now there is when you have ensured that you have some financial freedom, plus other investments that you might be having. Right? That is just an illustration of how buying and holding can maximize your profits. Now, we have other two, and I'm just going to mention them because it's like I've been able to explain everything. The other one is reinvesting the dividends, reinvesting the dividends, just like we have seen, like when the company declared the dividends and you are being given, instead of taking them, of course, the companies, those companies, they normally give the option of reinvesting the dividends in the same accounts. And of course, we have seen it even in the case of money market funds, plus other investments. Even when you do biological assets, you can decide that instead of me slaughtering all the goats, I'm just going to buy and multiplying them, and of course, looking for land where they can graze. All right. So reinvesting the dividends in the same account for a longer period of time is another one that is going to ensure that you have maximized the profits. Now, number 3 is actually diversification. This one I have been talking about, diversification. And when I talk about diversification, is identifying other areas. It's actually a risk management tool whereby you don't put all your eggs into one basket. And diversification is where you are going to diversify your projects in different areas. For example, you have a lot of money. Don't put all your money in a money market fund account, or don't buy shares of one company. Now, if your fund, kama una feeling fund yako ni kununua shares, then you can do shares in a energy sector, health sector, and so on and so on. That is called sector diversification. You can also do what we call asset class diversification, whereby you invest in different classes of assets. For example, you can invest in shares or stocks, you can invest in biological assets, you can invest in money market fund accounts, you can invest in treasury bills and bonds. Just make sure that you have some diversification as a risk management tool. For example, one area might be doing very well than the other area. That means if you invested all your money in an area that is not doing well, then you end up losing. But if you had diversified, you find out that some sectors are doing well than the other sectors. So diversification again is very important, and of course it also ensures security of your money and risk. You lower the risk. Now, ladies and gentlemen, that is it. That's how you can maximize your profits in long run when it comes to different investments. Now, if you're seeing me for the first time, my name is John. I'm a professional accountant. Make sure that you subscribe to my YouTube channel. Just ring that bell there, subscribe, and turn on the notification so that anytime I upload a video, you can be able to see it, all right? And don't go without liking the video. Just give me a like. If in case you want to comment anything, you want to ask a question, just put it there. And of course, even my number and my email are going to be on the description so that you can call me anytime you need to ask a question. Thank you so much and have a nice time. Just think about that. We meet in our next video.